All right, today we're deconstructing the exact mechanics of forming and optimizing an LLC for 2026. You know, for a lot of people, setting up a business basically just starts and ends with picking a cool name and getting to work. But expert analysis actually shows us that forming a limited liability company, well, it really needs to be viewed not just as a simple administrative checkbox, but as a highly calibrated engine for wealth protection and tax optimization. So if you're looking to stop operating reactively and really want to start architecting your financial infrastructure like a pro, this explainer is absolutely for you. Let's dive in. Here's the roadmap for our analysis today. We'll start with Phase 1, the simplicity trap, then move into Phase 2, structural engineering, Phase 3, capital isolation, Phase 4, income mechanics, and finally wrap up with Phase 5, advanced optimization. Kicking things off with Phase 1, the simplicity trap. You know, it's incredibly tempting to just jump right in, start selling a product or offering a service without messing with any formal paperwork, right? I completely get it. But operating without a formal entity creates a genuinely dangerous illusion of efficiency, and it completely masks some profound financial vulnerabilities. Strategic assessments actually reveal that default structures, like your standard sole proprietorship, directly expose your personal assets. We're talking your home, your savings, right in the line of fire for business liabilities. Plus, you're subjecting literally every single dollar of profit to heavy taxation. On the flip side, an LLC acts as a strategic shield. It offers separated liability, scalable tax elections, and highly optimized compliance.
So let's talk about the math here. The mathematical bleed of a sole proprietorship is precisely 15.3%. That's the immediate, unavoidable consequence of operating without an entity structure. This 15.3% self-employment tax is levied on all of your net income to cover Social Security and Medicare. It's a huge hit. And to make matters worse, expert reports consistently highlight that sole proprietors face statistically higher audit rates. Why? Because the lack of structural boundaries inherently leads to commingled personal and business expenses, which tax authorities immediately view as a massive red flag for noncompliance.
Moving right along to Phase 2, structural engineering and jurisdiction. Okay, so establishing an entity requires some really precise architectural decisions, and that starts with the absolutely critical choice of legal jurisdiction. Expert analysis actually completely debunks the whole myth of out-of-state registration for your average operator. You hear about it all the time, right? But the mechanism at play here is resident-based taxation. Basically, this dictates that if you live and operate in a state with an income tax, well, you're still going to owe that state's taxes, completely regardless of where your company's registered. So filing out of state merely introduces double compliance, double registration fees, and a whole lot of unnecessary complexity without actually offsetting any of your tax benefits. Bottom line, unless your LLC is strictly holding out-of-state real estate, you generally must file exactly where you physically operate. Now, once you've locked down your jurisdiction, the non-obvious mechanics of formation dictate this totally uncompromising sequence. First, you've got to file the Articles of Organization with the state. Second, you appoint a registered agent, and that's basically a physical presence required to receive legal documents during standard business hours. And third, you draft your operating agreement. You absolutely must follow this precise sequence to officially establish the entity as a legally distinct, recognized operation. Let's zoom in on that operating agreement for a second. This is a legally binding foundational document that establishes ownership rules, distribution protocols, and dispute resolution mechanisms. Now, there's a really common assumption out there that single-member LLC owners just don't need one simply because, well, they're the sole owner. Why make an agreement with yourself, right? But expert analysis warns that an ironclad operating agreement is an essential defensive blueprint. It's the core document that proves to banks, to lenders, and to the courts that your business is a legitimate, entirely separate entity. It effectively locks in that liability protection we talked about.
Which brings us perfectly into Phase 3, capital isolation.
Because look, establishing the legal paperwork, that's really only half the battle. The true integrity of a legal entity is entirely dependent on rigid rules of financial infrastructure. To prevent catastrophic liability exposure, operators have to adhere to this exact systematic sequence of capital isolation. Step 1. Obtain an employer identification number or EIN. Think of this as a social security number specifically for your business. Step 2. Use that EIN to open a dedicated business bank account. Every single cent of business income must flow into this account, and all business expenses must flow right out of it. And step 3, when it's time to pay yourself, you execute officially documented owner's draws. This transfers money cleanly and legally from the business account directly to your personal account. Now, if you fail to utilize a dedicated EIN and business bank account, it leads to a little something the legal system calls piercing the corporate veil. And trust me, you do not want that. It's the legal decision to basically treat corporate liabilities as the personal liabilities of the owner, and it's directly triggered by the commingling of funds. If you're buying personal groceries with a business card, or maybe you just deposit a client check into your personal checking account because it's easier, you're committing a fatal error. You literally destroy the liability shield you just paid good money to set up, leaving your personal assets totally exposed to any and all business litigation. But hey, mistakes happen, right? What happens if you accidentally use personal funds for a legitimate business expense? Well, advanced operators utilize what's called an accountable plan, which is essentially a formal reimbursement framework. Establishing this accountable plan ensures that necessary owner reimbursements remain correctly classified as tax-free transactions rather than becoming taxable events. It basically builds a legal firewall between your personal cash flow and your business deductions, preserving your capital isolation while keeping you perfectly 100% compliant. All right, let's pivot to Phase 4, Income Classification and Taxation. Understanding the exact nature of the income you generate dictates the entire tax strategy of your structure. Analyzing this matrix makes it super clear that classifying income correctly is a really high-stakes variable. For example, ordinary income from active services, basically trading your time for money, is fully subject to that heavy 15.3% self-employment tax. However, passive income, like what you'd get from rental real estate, is inherently shielded from that 15.3% tax. And then you have portfolio income from investments, which is subject to entirely different capital gains rates. Knowing exactly which bucket your revenue falls into is what allows you to engineer your entity to mathematically optimize those specific tax implications. So, once your income is correctly classified, you've got to systematically reduce your taxable baseline. You can almost think of the US tax code as an incentive system. It consistently rewards proactive documentation, allowing properly structured entities to really leverage specific operational deductions in 2026. For instance, you can immediately deduct up to $5,000 in startup costs before you even make a single sale. You can also deduct 72.5 cents per mile for business vehicle use. There's the home office deduction you can leverage, provided the space is strictly and exclusively used for business. And of course, professional services and legal fees, completely deductible. And here is a genuinely critical mechanism for 2026, the fully restored 100% bonus depreciation. Based on expert analysis of recent legislative changes, this provision is massive. It allows operators to immediately deduct the entire cost of qualifying business assets in year one. We're talking heavy vehicles, equipment, or even specific components of real estate identified through a cost segregation study. So, instead of slowly spreading a deduction over, say, 5 to 39 years, you accelerate the entire write-off. This drastically lowers your taxable income right out of the gate. Let's bring it home with Phase 5, Advanced Entity Optimization. Because here's the thing, as your revenue scales, that baseline LLC structure has to be strategically upgraded to maintain mathematical efficiency. A standard pass-through structure eventually just transforms into a tax liability, mainly because that 15.3% self-employment tax scales right alongside your profits, which obviously prompts a really vital question. At what mathematical tipping point does a standard LLC actually become financially inefficient? Well, expert assessments point directly to a very specific threshold, and that is $50,000. Once your business's net profit surpassed this $50,000 mark, the escalating burden of those self-employment taxes necessitates an immediate structural upgrade. Honestly, staying as a standard single-member LLC past this point is effectively just leaving thousands of dollars sitting on the table. And that brings us to the ultimate structural upgrade, the S-Corporation election. Deploying an S-Corp election effectively halts that 15.3% tax bleed on the entirety of your business profit. The mechanism behind it is pretty fascinating. Basically, it splits your income into two distinct streams. First, you pay yourself a reasonable salary through formal payroll. And yes, that portion is subject to the self-employment tax. But the remainder of the profit is taken as a distribution. And that distribution is completely exempt from the 15.3% tax. It isolates your tax burden strictly to the designated salary, which preserves massive amounts of capital.
Now, what about operators who scale way beyond a single business, or maybe start accumulating multiple real estate properties? For that level of scaling, expert consensus strongly recommends a more advanced architecture known as the parent-child holding structure. In this system, you use a central holding company to manage distinct, isolated subsidiary LLCs. Individual assets or operations are quarantined in their own separate entities right beneath that parent company. It's a brilliant defensive setup. If one property faces a lawsuit, the liability is totally quarantined to that single subsidiary, preventing any cascading liabilities from wiping out your entire broader portfolio.
So we've covered a lot of ground today. We've gone through the precise mechanics, the cause and effect relationships of liability, and the exact mathematical thresholds for structural upgrades. The financial system is mathematically designed to penalize the unprepared, while richly rewarding those who take the time to engineer proactive, thoroughly documented structures. So I'll leave you with this final thought. Will you remain a reactive taxpayer, or are you ready to transition into a strategic architect of your own wealth? Think deeply about how you can start optimizing your architecture today. Thanks for joining this explainer, and we'll catch you in the next analysis.